All right, let's jump right into something pretty fascinating in the world of AI stocks. Imagine two companies, they do the exact same thing, but for some reason, the market is telling two completely different stories about them, like night and day different. We're going to dig into why that is. So let me just throw this question out there. What if there was a stock that does exactly what Palantir does, but it's trading at, get this, just 1% of its valuation? Yeah, you heard that right. It sounds kind of crazy, and that's the big mystery we're exploring in this explainer. Okay, so let's introduce our two players. In one corner, you've got the heavyweight, Palantir, ticker PLTR. You know them. They're a huge name in AI, especially with government work. And in the other corner, we have Cognyte, ticker CGNT. Probably a name you haven't heard much, but they're playing in the exact same field. One's a superstar, the other's basically invisible to most investors. All right, now for the fun part. Let's look at the tail of the tape. When you put these two side by side, well, the difference in how they're valued is so massive, you're going to think we made a mistake on the slide. But we didn't. Okay, look at this. Their business model, identical. Both are in AI-powered analytics. But the numbers tell a wild story. The stock prices are way different, sure, but that's not even the main thing. The number you really need to see is the revenue multiple. That's just a way of saying how much Wall Street is willing to pay for every dollar a company makes in sales. For Cognyte, it's a super reasonable 1.65 times. For Palantir, it's a mind-blowing 113 times its sales. That is just a massive difference. Yeah, this chart really says it all, doesn't it? It's not just a gap, it's a canyon. You can barely even see the little bar for Cognyte next to the skyscraper that is Palantir. We're talking about the market paying nearly 70 times more for every single dollar of revenue Palantir brings in. So, what gives? Okay, so your first thought is probably the same as mine. If it's that cheap, it must be junk, right? The business must be falling apart. I mean, Palantir is a beast. Everybody knows them. They've got those huge government deals. That kind of thing earns you a premium. But is Cognyte's performance really that bad to deserve this? Let's check what the data says. And boom, here's the first thing that makes you go, Cognyte's EBITDA, that's a really good way to measure a company's actual operating profit. It grew by 81% in Q3. An 81% jump. That doesn't exactly scream failing business. That sounds like a company with some serious momentum. And then there's this, $576 million. Now that's what they call remaining performance obligations. Okay, that sounds super corporate, but all it means is money from deals they've already signed. It's future revenue that's basically guaranteed. So how big is that $576 million? Well, to put it in perspective for you, that's 1.5 times what they make in an entire year. So they've already got a year and a half of sales, already in the bag, locked in. That's a sign of a really stable business, not one that's about to fall off a cliff. Okay, so the performance is good, the future revenue looks secure. So what's the story here? What could happen to make Wall Street wake up and close this crazy valuation gap? Let's talk about the potential game changers that could send this stock up. There are a couple of big things to watch. First, they're just getting started in the US market, which is, massive. So there's a ton of room for them to grow there. And second, they've landed this huge partnership with LexisNexis. That's a really big deal. It could open up so many doors for them. And it's not just us noticing this stuff. Wall Street analysts are starting to pay attention. Right now, their average price target for the stock is $14, and they're getting to that number by looking at the exact same things we've been talking about. So let's just do the math. If those analysts are right and the stock actually hits that $14 target, well, from where it is now, that's an 84% jump. 84%. That's a real number that kind of puts a fine point on how cheap this thing might actually be. Which brings us to the million-dollar question, doesn't it? We've seen this insane valuation gap, we've seen that the business is actually doing pretty well, and we've seen the potential upside. So, is this a diamond in the rough, a true treasure, or is it a classic value trap? A stock that looks cheap, but is actually just a money pit? The source material we're drawing from for this explainer summed it up perfectly. It's one or the other. This is either a value trap or a 3x in 18 months. There's really no in-between here. It's a high-stakes bet. Either the market is just totally missing the boat and this is a huge opportunity, or there's a big scary reason it's so cheap that we just can't see yet. So, what's the bottom line? It all comes down to whether the company can actually deliver. And we're going to get our next big clue pretty soon. You're going to want to keep a close eye on their Q4 earnings report. That's coming in February 2026.
That report is going to be a huge signal as to whether Cognyte is the real deal or just a mirage.